The cost of starting a retirement plan for your small business may have prevented you from considering it before, but you may want to take a closer look at a potential credit that may change your mind. Watch this episode for more information on the Small Employer Pension Plan Credit.
Welcome to this episode of Accounting and Tax Tips, Smart Strategies for Small Business Success, with Certified Public Accountant Tina Moe.
Offering a retirement plan to your employees can make you an attractive employer and set you apart from your competition. It not only helps you attract and retain talent, it also provides an opportunity for you, the business owner, to set aside tax-deferred earnings for your own retirement as well. And to sweeten the pot even more, the IRS now allows certain small businesses to take a tax credit, making the idea that much more viable. The tax credit, known as the Small Employer Pension Plan Credit, is a provision of the Economic Growth and Tax Relief Reconciliation Act. This credit is offered to certain employers to help offset the startup costs and the cost of educating employees about the new plan. In order to qualify, you must meet the following tests. The first test is that you must have no more than 100 employees who earn at least $5,000 in the previous year, and as a side note, an employer with more than 100 employees may still be eligible if no more than 100 of those employees earned at least $5,000. The second test is that the plan must qualify for the credit. Plans that are eligible for the credit include SEP IRAs, Simples, qualified plans such as 401ks, profit sharing, money purchase pension plans, and defined benefit plans. And the retirement plan must cover at least one employee who is not classified as a highly compensated employee. Your plan documents will determine the application of the definition of a highly compensated employee, so be sure to check that out. There are certain expenses that are eligible for the tax credit, and these include the plan's startup costs to establish the plan, as well as expenses incurred to educate employees about the plan. The credit is limited to 50% of the first $1,000 in expenses. Therefore, the credit cannot exceed $500 per year for each of the first 3 years of the plan. Also, the credit is non-refundable. Therefore, the employer may not generate an income tax refund for the credit. And of course, claiming the credit is just one option. An employer may instead choose to treat the amount as regular deductible business expenses. Employers who don't owe tax may prefer this option since the tax credit for plan expenses is a reduction in tax liability. So what does that mean? It means that if the employer owes zero tax, he or she will not benefit from the tax credit for that year, but if an employer is unable to claim the credit in 1 year, he or she can carry it forward or backwards. Again, in plain English, you can choose to take the maximum credit of $500 for the year or deduct the expenses for establishing and administering the plan, whichever is more advantageous. If you decide to claim the credit, you must file IRS Form 8881, Credit for Small Employer Pension Plan Startup Costs. It's a really long name for a very small tax credit, but if you're considering establishing a retirement plan anyway, this might just be a little added bonus. And as with all tax law, there are copious amounts of complexity and rules, so be sure to consult your tax professional about this and other plan benefits, such as increased contribution and deduction limits and exceptions that apply to small business owners. For more information on the Small Employer Pension Plan Credit, visit my website at www.actservices-inc.com.
Thank you for watching this episode of Accounting and Tax Tips with Tina Moe. For more great information, visit Tina's website at www.actservices-inc.com. Also browse the other shows found right here at Indie Biz TV Shows.